Compass Mining is your trusted partner in Bitcoin mining. Whether you're investing in one machine or thousands, our customizable solutions are tailored to meet your needs. We are your experts in Bitcoin mining, offering a platform where individuals and businesses can purchase hardware, host machines, and access a range of ancillary Bitcoin mining services. We also specialize in large-scale site development and data center operations. Discover more at compassmining.io and see how we can power your success today. Hey guys, welcome back to the channel McNallie Money, the official home of power mining analysis. In today's episode, Anthony Power and I are joined for the very first time by Jamie McAvity. He's the CEO of Cormint Data Systems, one of the largest private Bitcoin miners in North America. We couldn't be more excited to get into today's discussion, but before we do, take a second, smash the like button, you guys. Big help to myself and the channel. If you're not already subscribed, McNallie Money, feel free to join. And let us know in the comments section below if you've heard of Cormint Data Systems before and how you think they stack up to some of the other miners we cover on the channel. Now, with that being said, let's get into today's interview. Okay, guys, so that's right. For the very first time, Cormint Data Systems, we've got the CEO, Jamie McAvity, on the channel, and we couldn't be more excited. This is one of the largest private Bitcoin miners in West Texas, a great operation that we're looking to learn a lot more about in today's discussion. So, Jamie, thanks so much for making the time, and welcome to the program.
Yeah, good to be here. Thank you for having me.
Most definitely. So, because it is your initial time on the podcast, we wanted to get a quick background on yourself, how you got into the Bitcoin mining space, and specifically Bitcoin mining.
Yeah, so I got into Bitcoin about 12 years ago. Well, a little less than that. I bought very close to the all-time high in 2013. I actually have a pretty amazing fill where I paid over $1,100 per Bitcoin in 2013, like 1,128, and the all-time high was about $4 or $5 higher. So, like many Bitcoiners, rite of passage, I bought the all-time high, and I was down about 80% within 6 months. And after that, I slowly became more and more interested in it, started evangelizing it to my friends. They told me I was an idiot. I was going to lose all my money, which was a pretty common reaction back then. And I do obviously wish that I had gone full time into the space initially, right when I had discovered Bitcoin. But unfortunately, I did not. And instead, I started a software company with a few friends focused on the multifamily apartment industry, which it was a great business. We ended up selling it and grew it from a startup company into a successful acquisition to one of the larger software companies in that industry. But in 2017, during the big 2017 bull run, when my small Bitcoin position grew to be a much more material portion of my investment position broadly and net worth, I just couldn't resist it and fell down the rabbit hole big time, started attending conferences, reading everything I could. I met my co-founders that year. We ended up starting Cormint as an LLC that year, and then we converted to a corporation in 2018. So we've been in business for 7 years now.
That's longer than most of the public miners out there that we talk about on a regular basis. There's only about 3 or 4 that have probably been mining as long as you guys have. Can you mentioned obviously Cormint there, you're the CEO. Can you talk a bit about the history of Cormint in terms of the team that you've got around you, your location in Texas, the type of power that you're utilizing there, and also, obviously more important, the availability of power, for growth in the future?
Sure. Yeah, so Cormint's first mines were in upstate New York, and we made the mistake that a lot of early miners make, which is we bought miners first instead of investing in infrastructure first. It's very hard to do that as a first-time miner, to sit down and do a solid infrastructure play right out of the gate and slowly prepare for mining. But the great thing about infrastructure is it doesn't lose its value as mining difficulty increases. It kind of holds its value. So we made that mistake where we bought miners first, then we were in a rush to do our first deal at it was kind of like a co-location type of facility, but we had to build out the infrastructure ourselves. That one went sideways, so then we were in a double rush to do a co-location deal because we had our miners losing value. That deal was even worse. And so right out of the gate, we had two very, very important lessons that I think all miners who do survive ultimately need to learn, which is always control your real estate and always invest in your infrastructure first before you buy miners. The third lesson, which is equally important, is make sure that you can control your power contract and your wholesale power market access. So we made the three cardinal sin mistakes of Bitcoin mining right out of the gate and got into a really bad situation. Through some luck and some very smart decisions, we were able to land on our feet, and we came up with three pretty important conclusions. Number one, got to control the real estate. Number two, invest in infrastructure first. And number three is you need to go to where the power is good and scarce. And so we began a nationwide search in 2019. We came across West Texas as this wonderful operating environment with a pretty open mind about welcoming and developing industries like Bitcoin and other cryptocurrency related companies and processes, whatever you have it. And West Texas is actually the renewable energy capital of the United States in terms of the percentage of their generation fleet installed that comes from renewable energy. I think it's close to 90%. So we then started to try and make our first purchase there and get stood up. To make that first infrastructure investment is massive. It's definitely a seven-figure investment, and you either have to be really good at raising capital or have a nice debt provider who sees that the value of high voltage infrastructure can be redundant across a variety of different industries, whether they're renewable energies, batteries, data centers, whatever it might be. Fortunately, we were able to find a partner who owned a wind farm. It was in a very distressed situation and it was in a state of disrepair. We told them that we believed we could repurpose their transmission infrastructure to build a Bitcoin mine. Bitcoin was booming at the time. The public companies like Riot and Marathon their stock prices were screaming. I think they were setting their all-time highs during that period. It was in late 2020, early 2021. And so we were able to present a very credible case that if we went through this difficult process of repurposing the transmission infrastructure from a wind farm to service a Bitcoin mining data center, that we could build a very valuable business, and that the electricity data from that region showed really favorable electricity pricing. So we came up with a crazy deal where they actually contributed the wind farm's assets to Cormint for a mix of equity, mostly equity, and some cash. And in turn, they became one of our larger shareholders, and they have a seat on our board of directors. And we started the process of changing the ground leases, getting the registration set up with utilities and ERCOT, and we had to get about 7 or 8 different deals done to switch it from a wind farm to a Bitcoin mine. But the end result was all the wind turbines were actually decommissioned and torn down by the previous owner, and all the ground leases were renegotiated, and the facility became permitted for a Bitcoin mining data center. The whole process took about 14 months, during which time the bull market completely ended. And we ended up energizing on October 5th, 2022 at this new location, and FTX imploded 30 days later. So it's like, okay, bull market is completely done here. And we were lucky to manage the risk well and get out of there. And so we have now scaled that site from our first deployment, which is about 15 or 20 megawatts, up to 130 megawatts where we are now. And we're going to be building an expansion site, hopefully within the next 12 months. So we've we were lucky to move our entire corporate headquarters to West Texas, manage that transition well. There were a bunch of risks that we navigated well, and now we're sort of stabilized and, like you said, one of the larger private miners in North America.
it's great to see that you learned a few lessons along the way, because believe you me, one of those peer miners you mentioned in the conversation there, they went down the route of asset light for quite a long time before they realized that was not the greatest decision. You need to have that control over your facility, when you're operating, especially, in when the Bitcoin price isn't rallying as much as we'd all like it to. Um, in terms of being based in Texas, I mean, we talk to many of the CEOs of the big mining companies out there, and the ones that are in Texas have really benefited recently, certainly from the power rates down there. In terms of yourselves, are you operating via a PPA or using market rates? And what sort of rates have you been able to achieve in recent months?
Yeah, so with our acquisition of the wind farm, we also acquired there's a subsidiary entity which is called a qualified scheduling entity. And a qualified scheduling entity is a participant that is registered with ERCOT to purchase wholesale electricity in the ERCOT marketplace. And so we were able to convert that registration from wind farm generation over to data center load, which is what a Bitcoin mining data center is. And at a base level, the way that a QSC works is you consume electricity, and as you consume electricity, you are just billed the real-time electricity rate from the ERCOT marketplace. That has been our default strategy for about 95% of the time. On top of those price signals, we are, or on top of that settlement mechanism, we're monitoring the real-time electricity price in ERCOT, and we've developed some proprietary software that has been recognized as the fastest and most efficient in the ERCOT marketplace for curtailing in response to high prices and ramping back up when the coast is clear. So that's our core strategy, is real-time electricity monitoring and then curtailing the mining fleet using software. We do some hedging where we'll buy a forward contract. We participate in the day-ahead market. We do a lot of congestion optimization. And generally speaking, I consider Cormint's core businesses are data center, research and development, construction and operations, and then commodity management. Commodity management is Bitcoin, Bitcoin options, Bitcoin futures, and then wholesale electricity trading. We are probably more like an energy company than we are a Bitcoin company at the end of the day in terms of our DNA. Between me, I used to be a commodity futures trader before I started that real estate software company. I was a commodities trader for about 15 years. And I have two senior advisors who between them have 100 years experience in electricity and commodity markets. So the company's DNA is in energy markets, and a Bitcoin mining load is a really, really interesting and dynamic electricity market participant that allows for a lot of optimization strategies, because you can turn it into a generator type of asset by buying a power agreement. In that, you can, the same way that a generator can turn on its power plant and generate electricity, a Bitcoin mine can lock in a power purchase agreement and consume all that electricity, effectively converting it to Bitcoin. But in the event that the value of converting to Bitcoin is lower than the real-time electricity rate, you can always shut it down. And so you have this option, this inherent put option on electricity. If you're unhedged, you can turn that into a call option on electricity. If you are hedged, and then toggling between those two, it opens up a lot of interesting optimization vectors. So we spent a lot of time trying to figure out the best way to optimize the mine. So far, we've been very successful in our 2 full years of operation, being 2023 and 2024. We were, I believe, 2.7 cents a kilowatt hour all in 2023. Last year, we were 2.25 cents a kilowatt hour all in. And I do think at some point in the future, a Bitcoin miner will post a negative cost of electricity. I don't know when that's going to come. I hope that it's us.
We saw that, Jamie, with I think I'm going, I think it was not this 2024, I think in 2023, in those summer months, if you remember, I think Iron were posting negative energy costs
They did,
I think it was
yeah.
July and August, not the whole year, but a couple of months of the hot periods. Um,
Yeah, it
they
was
were
August
benefiting. Yeah,
2023, and they had hedged almost
yeah,
their full load. And that month, you would have had about 65% uptime doing price optimization against the real-time price. And the remaining time when you curtailed that 35% of the time, the value of the electricity was close to $200 a megawatt hour. I think it was actually higher than that. So,
yeah,
that 35% versus their power purchase agreement rate of, call it, $50, it drove
yeah.
their all-in costs negative. The flip side of hedging, and this is something that's
Oh,
important, is Iris Energy was another one. They made so much money hedging in summer 2023, and then they got rinsed this
in
year.
2024.
They
Yeah.
yeah, they bought a PPA at I think 70 or $80 before the summer. I'm not exactly
I
sure.
think it was higher than
And
that, Joe. I think it might have been. I think it might have been double digits. I think
yeah, and
we've
then
got a
this
few
summer,
analysts. Some analysts did a bit of work on that particular one. I think, if I remember right, I've got the number in front of me, but I'm going to say 11.5 or something like that. It was higher than double digits. And then, but bear in mind, from previous periods, they did really really well. So they were playing the same cards and thinking if this happens again, but the weather and the demand didn't spike as it had previously, and they realized very quickly, and they made the move to get out of it, and I think they've now obviously recovered from that position. They're achieving sort of that I think they've just come out and said average of 2.8 cents for the whole of 2024. So a lot of these Texas miners, and it's interesting you bring your rates up there. That 2.25 it's on a par with being, I think, some of the cheapest energy we've seen from any miners. Cypher have always been communicating their price at about 2.7. Hut, I think, have just come in under 3 cents with their latest deals that they've managed to negotiate. But 2.25, and I know from some of your previous financial updates, because you do, even as non-public money, you do issue financial updates, and I put some of those in my analysis to show the margins that you guys were achieving, and you were basically achieving some really good margins. Probably about a year to 8 months ago when I was covering Cormint, in a bit more detail as a comparison. Um, but no, that's really good to. I'm assuming obviously with the power in Texas and ERCOT, you're also benefiting from the 4CP programs, etc. You're part of those.
yeah, generally speaking, we are, there's ERCOT's a funny market where there's always an economic incentive around the ability to curtail you, the transmission charges related to being curtailed or not curtailed. There's congestion dynamics that flow off of whether or not you're curtailed during certain intervals. So you always have to be watching. Generally speaking, if you are loaded during the four summer peaks, June, July, August, and September, each one of those peaks for you to be loaded, it adds $1.50 a megawatt hour to your power costs for the entire next year. So, you multiply $6 in total times 8,760 number of hours in a year times the number of megawatts in your load, depending on where Bitcoin mining break-evens are, it can make sense to remain loaded during the 4CP period and just take those transmission charges on the chin. So, like during the 2021 bull run, Bitcoin mining revenue break-evens were north of $300 a megawatt hour. And so to pay a $6 a megawatt hour transaction fee or transmission fee for the entirety of the next year, when you're making $300 a megawatt hour, it's tough because in order to avoid 4CP, you have to curtail quite a bit during the summer because you don't know when the peak is going to occur. So you can be conservative or you can be aggressive in pursuing that goal. And the cost of pursuing that goal is that you're not mining during a period where you could otherwise be making a bunch of money. So it all gets put into this big optimization equation. Cormint uses old generation, less efficient mining equipment as our default strategy. And, because of that, we are very aggressive in attempting to avoid 4CP. And we've been pretty successful in avoiding those peaks throughout our operating history.
Hey, Jamie, one follow-up. This is a fascinating background, and obviously you have a lot of insight into the power market itself. You mentioned your relationship with the wind farm as your company got going there. I wanted to bring this up. We spoke about it briefly before we started filming. We've heard President Trump come in and say he's pledged to reduce power costs by 50% over the next 12 months. I had started talking to you about this, and you mentioned wind was a main factor in that equation. So I just wanted you to maybe provide some clarity on your perspective of the incoming administration, the power prices in your West Texas market.
Yeah, yeah, it's Texas is such an interesting market, right? Because it is deregulated. It has the least amount of red tape of any electricity market in the country. And over the last 15 or 20 years, the federal government has been subsidizing the development of renewable energy with their Biden renewed it in the Inflation Reduction Act. And prior to that, you get paid a huge tax credit to build and generate wind and solar electricity. So Texas doing what it does and being the best and freest market in North America, they've built a shitload of renewable energy. There's 36 or 37 gigawatts of wind that have been built in Texas over the last 20 years. And now solar is going to be at or greater than that within the next 12 months. It's been doubling the last few years. Most of that has been built in West Texas because West Texas has an abundance of really cheap land and very good photovoltaic conditions for solar generation. And because it's so long and flat, it has excellent wind generation capabilities as well. So we had all of this renewable energy that was built out in West Texas, subsidized by the American taxpayer. And if Trump comes in and says, "Hey, I don't want any more wind in North America," he's already said that about offshore wind. He hasn't said much about onshore wind yet, other than his one sweeping statement that wind is pollution for the horizon and environmentally destructive and worthless, and we're not paying the subsidies, is what he said. I'm sure that was terrifying if you owned a wind farm and you're collecting those subsidies. But in the event that the country were to radically shift its policies around renewable energy tax credits, and those tax payments didn't flow to existing projects and they stopped building new projects, then you could see that Texas would actually become more expensive in the short run as some of the other power generation types got built. Really, what you'd like to see in a perfect world is a much higher penetration of nuclear and natural gas. That'll really drive power costs down and increase grid reliability. So from an energy policy perspective, we do think that renewables, because of their intermittency, are not a great choice. But Texas has responded to those free market incentives of tax credits. I mean, it's not a free market incentive, it's a subsidy, but the Texan free market and the ability to build stuff quickly and do development quickly in Texas responded with a huge push to build all these renewables, and the underwriting made sense. If that goes away, Texans could suffer short-term higher energy costs, but I'm confident in the long run, if they really do let natural gas generation boom and reduce the red tape on nuclear, Texas will continue to have some of the cheapest energy in the country.
Yeah. Just a final question on the power before we move on to sort of hash rate. With your current, and I think I looked on the website, 130 megawatts available power, is that sufficient at the moment, obviously, to meet your current requirements, but to meet your growth strategy 2025 and onwards, or is there potential to increase that amount?
So we're an on-grid miner, and on-grid miners are all governed by the same transmission study process, where both ERCOT and whatever local utility services that point of delivery, they have to study the effects of consuming that much power on their system, and they're basically studying a number of contingent scenarios where generation is here, not online, load is here, transmission is X, and batteries are Y, whatever it might be. And they are trying to understand the likelihood of being able to serve your load 100% of the time, which is what they're underwriting for. Unfortunately, in the transmission planning process, they don't account for Bitcoin mining flexibility and its ability to curtail. There aren't programs in ERCOT right now that you can sign up for that basically commit you to curtail during any transmission related emergencies. If there were, then many Bitcoin miners would be able to build much more data center capacity, and they'd only be constrained by the velocity of their construction teams. Currently, they study all these loads as firm loads, so they presume that you will need that electricity all day, every day, 24/7. And we are limited by transmission studies that we conducted 3 years ago at a time when there wasn't quite as much electricity demand. Currently, our Fort Stockton site has 130 megawatts of limit on it. With the infrastructure we have there, we could go up to 175. We're trying to get there. And we're also investing in the legal, the contract, the permitting, any infrastructure that would be required to expand beyond that. We're contemplating building power generation ourselves at that location. So we're trying to do everything we can to expand our footprint. We're currently limited to 130 in our one location, but we do have an expansion location that'll come on, hopefully get us up to about 170 of additional capacity. So we'd be targeting being at about 300 megawatts at this time next year from 130 right now.
Yeah, I noticed on the website, I think it mentioned a long-term plan to get sort of like 500. So I could see you getting, growing there. It was just a case of what was available at the current location, whether it was a case of going to other locations, like we've seen a lot of these other peer miners do the same over the last 18 months as well. Brad, should I cover hash rate?
Yeah, we'll jump into hash rate. So that's great that you provided some detail on the power capacity, Jamie. Are you able to share any details on current hash rate and planned or future hash rate for Cormint as well? Compass Mining makes Bitcoin mining accessible to everyone. Start mining in as little as 48 hours with our turnkey hardware, online and mining directly to your Bitcoin wallet within 2 business days. Find out more at compassmining.io and get started now.
Yeah, so we have 115 megawatts of capacity online. It's all mostly older generation mining equipment, so it ends up being between 3 and 3.5 exahash. But if we were to upgrade that to new generation mining equipment, it could be around 7 exahash. If we do more than double to 300 by this time next year, depending on what type of mining equipment we use, we will have somewhere between 8 and 16, maybe 9 and 20 exahash online. So it just depends. Cormint is unique in that our DNA is in buying other people's garbage, so to speak. So we've bought about 45,000 old generation miners. They're all used. They all come with problems. You have to be able to repair them, diagnose them, do swaps. And our team is trained in all of the necessary repair skills to be able to sort of ingest a big pile of somebody else's garbage, put a little love into it, give it a kiss, and plug it into our data centers and get it back operational. So it's an economic calculus. Obviously, when you receive a bunch of old equipment, you have to put time into repairing it. You have to account for the fact that some of it is probably going to fail. And you have to account for the fact that when some of it does fail, you're not going to be able to go back to the manufacturer and say, hey, I want another miner, because most of this stuff is out of warranty and is by its very nature more than 1 year old. So a little bit of a different model that we use. We call it the graveyard because we believe that
nobody else wants them.
It will be the last place where they're ever run is with Cormint, and we will run it until it can't possibly run anymore. I don't know that there's anybody who will accept equipment in worse condition than us. The end result is that we've bought some miners at extremely low prices. I think the lowest price we paid during the last 2 years was 60 cents per terahash. You don't really see deals that clear around that price. And I mean, that deal in particular, like a third of the equipments were showing as non-functional or two hash boards. There was just all kinds of hair on it. So we paid 60 cents per T. We probably put another 60 cents in labor costs in actually getting something close to that amount up and running.
Did you see the update? I think it was Iron actually. They sold a ton of S19s, and they were selling them at, if I remember rightly, I think it was $200 a rig. They sold a whole thousands and thousands of them,
Mhm.
and me and Rob, we commented it on the podcast, and we said, how much are they going for? We did a quick check, and it was like, the $1,000, but when you're selling, it might have been 40,000, but at such a low price, if you start looking at the price per terahash, you're not
Mhm.
that far away from what you're paying there effectively. For
Yeah,
for what
$2 a
for what is,
T.
bear in mind, Iron have been mining just over 3 years, so
Mhm.
they're not an old mine. I brought Iron onto the analysis when they publicly became public in, I think it was October, November 21.
Yeah, I mean, $2 a T, that's kind of where.
Probably good for miners in good condition, because they just literally placed it with all S21s. They just wanted to go down the route of getting the best efficiency and the cheapest power to give them the best margin. But what you've done, what it highlights in listening to you speak now, is the fact that your energy price is enabling you to use older mining machines, because no other miner out there, not because they couldn't. There's a couple of miners that have got a fleet efficiency around about the 30 mark, but they've not got big mining fleets.
Mhm.
Most of them now are coming down into that low 20s and sub 20 mark there, and we'll come on to a question shortly about your fleet efficiency, but it shows me that your power cost to make money and to keep going is really really effective in this type of environment.
Yeah, it's true, and there's some caveats. Like I can't just sit here and say like, we get 2.2 cents. We're just better than everybody. We have been, and the result of that is if we were to run our fleet 100% of the time all year long, our power costs would be higher. We are doing an economic calculus every day of how much can we convert a kilowatt hour of electricity into, a corresponding amount of Bitcoin, and what's the dollar per kilowatt hour equivalent of that conversion ratio. And then our curtailment software is very fast, so we're attempting to never do that at an unprofitable rate. And so while we do have the lowest power cost by a healthy margin in the industry, we also have the lowest uptime because we are constrained by
Choosing
how
when.
often we're
Yeah.
going to be mining in order to do that. Ultimately, we believe that's the most favorable way to approach the business, because even with a lower uptime and a lower power cost, the cost of all-in acquisition per terahash using our data center process. So we design, build, and operate all of our own proprietary infrastructure. On the data center side, we do it really cheap. And then we buy these old miners, we refurbish them, and we try and milk the last little bit of life out of them. We're actually net quite profitable on that trade. We're just a bit scrappier, and we embrace a little bit more risk in the business model. And so, you have to make a consideration about the decreased uptime, the seasonality in earnings. Most miners have seasonality in their earnings. We have way more seasonality in our earnings than your average miner, because during the summertime, there's a tremendous amount of demand for power. And so our miners aren't mining during that time. But generally speaking, our philosophy is that where mining is heading is, if you look backwards on where mining has come over the last 10 years, it's going to look very different going forward, where most mining companies are playing for a call option on Bitcoin. They want to raise a bunch of equity, and their executive teams will take a bunch of stock-based comp. Then they buy the latest and greatest Bitcoin mining equipment from Bitmain or MicroBT. And if Bitcoin rallies, they're going to make a killing. And that trade has worked for the last couple of cycles. We think that that call option is becoming less and less valuable as Bitcoin grows into a multi-trillion-dollar asset. You know, if you look at 2017, for example, Bitcoin went up by 4,000% in 2017. A 4,000% rally right now would be Bitcoin's price going from 2 trillion or market cap going from 2 trillion to 80 trillion. So you'd be talking about adding, you know, an enormous quantity of value into Bitcoin's market cap to do that 40x. That 40x in 2017 was significantly less. It was, you know, in the hundreds of billions. Now you're talking about in the tens of trillions. And we just don't think those order of magnitude of percentage increases are possible. Bitcoin's volatility is going down. Its ability to go up by thousands of percent is lower. It's also not going down by 50% in a day anymore, which is great. You know, allows you to sleep a little bit better. So from that view, we look forward and we think that mining economics are going to be much more focused on being a put option for stranded energy and the ability to divert energy into a mining fleet where there is no buyer, and you can do it at the nodal location, at where the power is being generated in a transmission constrained region like West Texas, that put option is going to be where Bitcoin mining looks the most valuable. And from that perspective, it's going to be companies that own lots of energy generation who are going to see that value more readily. They're the ones who bear the brunt of $0 pricing, negative electricity pricing. And so they'll say, hey, you know, maybe we should add a big Bitcoin mining fleet into our operation because it can help us alleviate transmission related issues that lead to economic underperformance of our generation fleet.
I'm assuming that as you're growing hash rate, it sounds like you're looking at ROI on machines as a sort of guidance for you to determine whether you're going to buy new or older replacement machines to change or to add to your current hash rate. Would that be correct?
Definitely. Yeah, we're always oriented around making our money back.
Yeah. I mean, we've seen some of the big miners, they go out there and they buy the latest shiny new mining machines. And sometimes it works and sometimes it doesn't work. You know, we've had issues with the T21 batches. The S19 XP had a lot of batches. I think 2 out of every 5 batches were faulty. So we've had some track record of machines not working, but it sounds like you guys have got a system in place there which delivers what you require. You highlighted you had technicians on site that can repair. So do you carry out all repairs on site? Is there any requirement to outsource repairs, or is everything covered on base?
We can handle a good bit of it in-house. We do have a partner firm called LFG Mining that we use for repairs, and we've had a great time working with LFG. They're West Texas based. They can handle a lot of work that, you know, that our team or on-site staff just, it doesn't make sense for us to divert all of their focus onto one task, like rehabbing 5,000 miners, for example. You know, that would take up most of our staff, most of our time, and then we wouldn't be able to pay attention to our existing operations. So having a partner like LFG that we can flex some additional workload into without taking our eye off the ball in the existing operations, it really helps a lot. And then those aren't full-time staff. So we staff the operation for the full-time anticipated needs of keeping the equipment that we have up and running. And then when we have some surplus workload that's time sensitive, a company like LFG can step in and really help out. We think that's the right way to do it because at the end of the day, if you have a bunch of mining capacity that's open and you have a bunch of mining equipment that needs to go through the rehabilitation process, you're losing money every day that you don't get that rehabbed and plugged back in. And so it can make sense to make an incremental investment into some contract labor to help you get those additional units rehabbed and plugged into your facilities. But when you're at a steady state, or if you're constrained for growth by your transmission studies, then it does not make sense to have that on your full-time staff. So it's good to be able to flex into that, and we love working with LFG.
Makes sense.
I'm just conscious of time, so we'll try and get through some of the next questions a little bit quicker. In terms of your system you're using at your site at the moment, I mean, I seem to remember it was you're using immersion cooling there. Am I correct in saying that?
We have about 35 megawatts of immersion and 95 megawatts of air cooled now. Actually, we stopped building immersion when the cost of miners dropped below $3 a terahash, because spending that much extra money on your immersion infrastructure. Yeah, I mean, at $2 a T, we're spending 60 grand a megawatt on miners to build immersion capacity at 250 grand a megawatt. For those miners, it doesn't really make sense. You can buy more miners if you build air cooled cheaper. Our air cooled is about $100,000 a megawatt to build, and that's all in cost. So, we're just trying to get the most hash rate online. So, immersion makes more sense when the miner costs are higher. But for the last 18 months, we've been all in on air cooled.
Now, Jamie, you mentioned you're utilizing older or renewed graveyard mining rigs at your facility there. What is your current hash rate efficiency or fleet efficiency, and where do you see that going as you start to expand in 2025 here?
It's about 35 joules a T is our blended efficiency. A lot of that is from it's getting dragged down by M30Ss, which are a large portion of the fleet we have. Those are we love those units. They're extremely reliable. They have great thermal performance. MicroBT makes great products, and they sold a lot of them. So there's a lot of them out there that are for sale on the secondary market. Ultimately,
we got 10 Bryce M30s.
No, ours are 31S plus or something.
Okay. Maybe we can send them down to Cormint to start in.
Yeah.
We actually don't love the 31s.
All right,
we're joking. These are prizes for our competition, so we can't really use them.
Yeah. No, the 30s are great. I mean, we pretty much try every piece of mining equipment that's on the market and try to get a handle for its thermal sensitivity, its performance, its footprint, and then you have variability between different batches. Bitmain in particular is known to change the footprint or the power supply or the control board of different batches, even though they have the same name. So if you're going to be buying on the secondary market, you have to arm yourself with as much information as possible by owning and using everything. And then at the end of the day, we're just mercenaries about finding the best value in the market in terms of shortest payback time. We're pretty active with derivatives and hedging. So we try to hedge as much of our production as we can, with some respect to potentially having short-term bullish or bearish views on the market. But I think we're probably amongst the more active miners in terms of hedging our production and then just trying to use it to generate the highest dollar per megawatt of value that we can.
In terms of, I guess sense from your answers about Bitcoin mining, but we have to ask about HPC because a lot of miners have pivoted towards HPC. Initially, it was like 3 or 4. Now it looks like everyone bar maybe 2 of the miners are going that route. Is it something that you're sort of like paying a watchful eye over? Does it offer interest? It sounds like you do everything very methodical on a return of investment. But is it something that you're keen to expand it? I mean, it's obviously capital intensive, whichever route you go.
Mm-hmm. I mean, don't get me wrong. I love that my competitors are taking their eye off the ball and focused on this shiny new
Great for
thing.
you guys.
It's good for us. We're simple folk out here in the desert. We're diving the dumpster for other people's trash and trying to squeeze some life out of it. I understand why AI and HPC is so attractive. I mean, at the end of the day, Cormint owns and operates high voltage infrastructure, and AI and HPC customer cohorts are willing to pay a much higher dollar per megawatt hour for access to large quantities of wholesale electricity. So that is the overarching fact that is unavoidable. We are in an AI HPC arms race of sorts as the species pursues who can get to AGI first. A huge amount of electricity and computing power is dedicated towards doing that. And the firms that are deploying those computing resources, they seem to be extremely insensitive to price. So, you have all of a sudden this high voltage infrastructure access market has gotten disrupted with a massive buyer that's coming in and disrupting the pricing scheme that this infrastructure would normally trade at. So that's like the high level business guy, guy who's in a spreadsheet only. That's the way he thinks about that. The fundamental reality of it is that the way that you will make an outsized return on converting your Bitcoin mining data center into an AI HPC data center is to do what Adam Sullivan has done over at Core Scientific, which is he has landed very long-term contracts with customers who have extremely high credit ratings. He can finance the construction of those buildings by getting cheap debt. Banks love that. They love to see that a hyperscale client is your off taker, or now CoreWeave is considered highly creditworthy as well. And Adam's been building that relationship for a long time. I think that now that everyone and their mother is going and trying to win those relationships, I would expect to see that some of the AI HPC hyperscale firms are going to be having some more pricing power in some of those negotiations. To me, it's not clear how we would differentiate ourselves and win that business from everybody else doing that. That being said, we would be bad fiduciaries of our shareholder capital if we weren't doing it, if we weren't looking for the maximum way to monetize our assets. So we are looking into it. We've been doing so for about a year now. I haven't found a way that makes sense for us to do it. We're not a publicly traded company, so teasing out announcements like that, we don't get a share price bump. It doesn't help us raise capital. And also, we like mining. We think this is the time when you should be investing aggressively. We think got a bunch of layer twos launching, a bunch of other stuff happening that's exciting for Bitcoin, could see more pressure on transaction fees. So we're not taking our eye off the ball now, but you can see with mining difficulty, it's kind of flatlined a little bit. So it does seem like it is potentially having an effect on the market.
In terms of closing out the conversation, I mean, you've mentioned a couple of things there that are really, important. One is the funding aspects of whichever growth strategy you look at, whether it's Bitcoin mining or moving into HPC. You've highlighted that HPC at the moment is attracting cheaper debt on the market, far significantly cheaper than Bitcoin mining ever has. And we've seen all these convertible notes in recent periods. How are you going to manage going forward in terms of funding to grow as a company? And are you sort of like, do you have a sort of like a strategy to public list yourself? I mean, you are bigger than quite a few of the public miners out there that even on our platform.
I have our early estimates for financials on 2024. We did about 14 million in mining operating profit, which is revenue minus power and all OpEx. It's our version of EBITDA. So we did about 14 million in EBITDA on 32 million in revenue. The incremental cost of us going public has been estimated to us by some bankers and advisors as between $5 and $10 million. So right now, going public, it does seem like we'd be spending a healthy bit of our profit margin in doing that. We're certainly right on the edge of being able to do that with 14 million in EBITDA and 32 million in revenue. We're intending to grow the business by more than 100% this year, and then hopefully we can keep up that trajectory of more than doubling the size of the business each year. We're beginning the process. We've got 2 years of audited financials from an auditor who audits a bunch of publicly traded mining companies. We're talking to bankers. We're talking to some of the shells out there that might want to reverse merge into a large private miner like Cormint, and we're dancing slowly.
Would that be like in the same way Griffin Mining came to the market?
Yeah, I think there's been a few reverse mergers where you have a shell and then the shell basically gets diluted by 90% or
Yeah.
something there. And
Yeah,
there
an asset like Shell. Yeah, and yeah.
yeah, and there are a bunch in the industry that were already focused on mining or focused on something
All
else.
right.
We're looking at SPACs, we're looking at IPOs, we're looking at all of the possible ways to do it. And one message I would say is, look, we are open for business. We're open to do a creative deal. There's a lot of people who would like to be Cormint shareholders who can't be because they're not accredited investors. The company holds itself to an extremely high standard of disclosure and financial reporting already. So hopefully the transition won't be too hard. We've got a friendly SEC and a friendly presidential administration. Now is probably the time to do it. So we're marching towards it with a goal of being public by this time or earlier next year.
I think the fact that you're doing what you're doing, with your financial presentations probably helps you on that route as well, because you're probably fulfilling some of the criteria already in terms of like disclosure and things like that. It's not going to be a massive leap for you to meet the requirements. Final point before I hand over to Bryce. You'll obviously be pleased with the news today that Riot have decided to not utilize the 600 megawatts at Corsicana for Bitcoin mining for the foreseeable future. They're now focused aggressively, I would use the term, on HPC AI opportunities out there.
Yeah, look, I think that's a good move. When you got 600 megawatts in a single location and it's got a good proximity to long haul fiber and ample land, you could probably make more
Absolutely.
money selling that to a hyperscaler. The break, you really get those guys interested when you got more than 300 or 400 megawatts in a single location. So 600 is great. That's kudos to Riot for doing that, because they're probably going to create a bunch of value for their shareholders by doing so.
That's the hope. Hey, this has been a great conversation, very insightful into the business and your background here. So I just wanted to pass the mic back, give you an opportunity to close out if there's anything we've missed, Jamie, and thank you once again for your time today.
Oh, I get an open mic. That's exciting. So I'll say this to the world. I'm going to speak to the layer two developers out there. In the broader cryptocurrency industry, you have it seems like the scheme is make token that I get to sell and become rich is the first step. And then from there, you walk backwards to how do we try to bring this to the market in a way that's credible so that investors will give us money, people will buy it, and we can get the token listed on some exchange and we could sell it to retail investors. That's fine. Look, it's okay to make money, and I'm not going to sit here and wag my finger at you, but we should, as an industry, take a lesson from how Ethereum has fragmented its ecosystem by having so many different layer twos with so many different tokens, many different scaling solutions. It's a fucking mess. And that is why Ethereum was the worst performing token of 2024 amongst all of the major tokens, and why the enthusiasm and energy around their ecosystem has never been lower. We can't let that happen to Bitcoin. The layer one and layer two incentives must be aligned. And Bitcoin miners who have the most illiquid representation of Bitcoin ownership of any market participant, in that it's steel in the ground, it's stuck in a single location, it's infrastructure with very long depreciation schedules, and ASICs with medium to long-term depreciation schedules. You have this very illiquid invested form of Bitcoin exposure that's already validating your layer one transactions. If there's going to be a layer two scaling solution that's built on top of Bitcoin, there has to be a way for miners to participate in it. Whether if it has some token distributed to the Bitcoin miners, ideally, doesn't have that route. Ideally, it just contributes to fee pressure on the layer one and pays into the block rewards that the layer one miners are going to be earning. Because if you have solutions that fragment the incentive alignment amongst the industry and fragment the liquidity as well, then there is a good chance that we end up with the same problem that Ethereum has, where users are sort of bouncing around between these layer twos. They don't know which one to pick, and you end up getting a very low concentration in a single scaling solution. So that's my message, layer two people, is don't forget about the miners. We're sitting here working hard. Mining is not a glorious profit-making business. It's a hard steel in the ground, long-term CapEx, more like an industrial infrastructure type of business. Don't forget about your local miners.
There you go. Transaction fees, and don't forget your local miner. Jamie, this was a real pleasure. We look forward to having you back on soon. You guys hit the like button. Feel free to subscribe. Let us know what you think of Cormint Data Systems in the comments section below if you would like to see them go public and if you would potentially purchase shares in this company. Thanks again, Jamie. We'll talk to you soon.
Thanks, guys.